Welcome back to the second half of our show. Traders, we're just 60 minutes here until we get the equities cash open here in the U.S. We just had some numbers which just got released here. Let's bring in our next guest for a look at the 7:30 numbers here and the market reaction to them. Traders, this morning we have Alan Nuckman. He's the Chief Market Strategist at Agora Financial. He's joining us. He's perched high above the trading floor at the Chicago Board of Trade here in Chicago. Alan, thanks for taking the time to be with us this morning. It is much appreciated. I'd like to begin with your reaction to GDP and jobless. I mean, I'd imagine for the most part GDP is a little bit more closely watched. Jobless continues to point towards a tight labor market. What are you seeing in terms of growth?
Well, there's no surprise in the GDP number. So we were expecting 2.2, came in with a 2.2. So it's been revised down, after all this. So, there are some people that are going to use this number to support the idea that the Fed, cannot continue to raise rates. But the sharp reversal in sentiment and psychology is something that I still question. The data is going to continue to come out soft, but we know that. This is no surprise.
So, Alan, when you say the sharp reversal in sentiment, you're talking about this major shift that we've seen from the Fed from, their last meeting in December to recent, the meeting where they said basically they're going to push back rates to the end of 2019 at the very least. I mean, talk to us about why that kind of has you a little bit out of sorts.
Well, and we talked about this a couple weeks ago, that the markets are actually pricing in a rate cut if you get out to 2020. So it's a complete turnaround. It's a complete shift in the mentality that, that we're continuing to grow at a pretty healthy pace. So that's kind of making me think that they're somewhat negative for whatever reason. Now, it could be just talking their own book. I mean, I don't want to make this too political, but, the latest appointment to the Fed is talking about cutting rates immediately by 0.5%. And, so you got to think, has the independence of the Fed been completely thrown out the window? I know that I'm not going to worry about the political aspects of this as much as I'm going to focus on the price action. But we're seeing the price action and the 10-year note continue to just, the yield continue to just completely dive. Now, that is a positive where I come from, old school, making it very, very simple. If yields are low, that'll help other asset classes. Money's got to flow somewhere, and if it's not getting it in the payoff in the treasuries, it's going to go in equities, and it's actually going to go into some of these commodities markets that you just talked about in the last segment.
Yeah, Alan, we could talk about these rates and potential ripple effect or the inward impact that they're feeling from some of the growth and concerns associated with economic conditions till we're blue in the face. But let's move on. Let's talk about and take a trip across the big pond. I want to get your thoughts on the stalemate that we've seen in terms of Brexit negotiations. The dollar remains very strong for the most part. We heard Draghi comments this week. I mean, all of this, it's all so intertwined together. Weakness in the euro currency related to Draghi, weakness in the British pound associated with some of the Brexit uncertainties, and the dollar remains here holding in the mid-96 handle.
But nothing is happening.
For the most part, right?
Absolutely nothing is happening as far as the market action. So it's extremely interesting to me to see how how prices are reacting, and they're just doing absolutely nothing. If you look at the FTSE is up 10% in the last 3 months, and it's up a couple of percent in the last month, even with this issue just continuing to fester. So if you look at the currency, if you look at the British pound, it's really hanging around this 132 level at the upper end of the range. Let's remember the recent lows are at 125. So it is not having any negative impact at all on price. To get back to the dollar keeps going around that 96 pivot. Every time it looks like it's going to break down, if you remember, it was down near 1.5 month lows here just recently, bounces back. Every time it bounces back. But how is that possible if we're not going to raise rates ever this year, and we're probably going to cut rates in 2020? So it's a conundrum wrapped in a riddle right now.
Alan, you're talking about markets that haven't really gone anywhere when you're talking about the dollar in terms of bigger picture holding mid-96, but talk to us about the New Zealand dollar. That's a little bit of a different story. Yesterday we saw that move in reaction to them actually pointing out that they actually may be cutting rates, moving from a neutral to potentially a rate cut is what they said. We've heard about central bank dovish. This is no doubt becoming a bit of a trend. I mean, we're talking rate limbo at this point. How low can they go? And yes, dollar is definitely tied to this as well, but how about the New Zealand dollar and the Aussie coming off yesterday?
So it looks like we're deja vu all over again. It looks like another race to the bottom. You know, we remember this a couple years ago. We had this contest to see who could continue to dive, and you know, we'll see how it all rounds out. But in the big picture, you know, I look more at the yen as a kind of an indicator of stability, and you can see the yen right now just hanging at this 90 level. It's down near its lows, you know, 89. And if you look big picture over the last 5 years, you've got a huge wedge there where it traded between 80 and 100. 90 is the midpoint, and we've come to this midpoint. Now what's going to happen? I've got to wait and let the markets come to me and tell me what's happening, where this breakout is in any of these currencies. And you know, right now to try and predict what the catalyst is going to be, that's not the job. That's not our job. Our job is to profit from price action. I don't know what's going to be the catalyst to make these currencies break out, but it definitely looks like something's going to happen. But at the same time, I said that weeks ago, months ago, it still hasn't happened yet.
Alan, is it possible that the next catalyst could potentially be, well, the pillar of strength that we've seen, the job market? Next week we'll get a little bit of information about that. For the most part, this has been the one thing that we've been kind of holding on to, as it has been very strong, unprecedentedly strong. Talk to us about how that could potentially be the next catalyst if we were to see some weakness there, some cracks in the dam.
Well, even we saw weakness last month. It was just more of an aberration. It was still positive job growth. It's just maybe not as positive as we would like. But I don't know how many months are we working on. Are we working on like 70 or 90 consecutive months of job growth? So that I don't think is an issue anymore. When I was a kid, you know, you were down here, you know, that was the biggest deal of the month, was looking to see what the job number was. And everything hung on that. Now it has a very limited impact. And, you know, even these Treasury moves seem to have a very limited impact because we're still at such low rates. Until those are normalized, I don't think that's going to have much impact. In the big picture, we just continue to have to focus on the macro market. In the macro market, if you're looking at stocks, you know, just last Thursday made new swing highs. So it's been, what, we're working on 1 week since the new swing highs. So we back off. But every time it does back off, it stair steps back higher and makes a new relative high. Until it stops doing that, we've got to respect the trends are what the trends are. And I talked about this a couple weeks ago, and I know people scoff, but I'm using Apple as an indicator. And Apple got above its 185 level, which is a midpoint of that drop from the top. That's a very positive sign. And so, you know, the stock market itself had done that a long time ago, back in mid-January, where it recovered half of its losses. Now that Apple's done that, that could really help out, give the stock market another push to the upside, because it's obviously such a big, heavy weight in all of our indexes.
Alan, really insightful. I appreciate you joining us here this morning and helping us break it down in terms of some of the activity we've seen in currencies, rates, and across the board, basically, the financials. Really appreciate it. Much looking forward to seeing you back here in the near future. Traders, it's Alan Nuckman. He's joining us from the trading floor here in Chicago at the CBOT and from Agora Financial. Now I want to take a look here, guys, at the treasuries. We've been talking a lot about them as they've been impacting all of the markets that we focused on here for the most part throughout the day so far this morning. And I want to take a look here, guys, at some of the overnight activity that we saw as the bonds extended the rally. Now, interestingly enough, the 10-year, for the most part, was kind of limited in